Welcome back. Today, we are unpacking a seriously fascinating financial year for a true heavyweight in the B2B manufacturing space, Amber Enterprises. If you track the manufacturing sector, you already know Amber is a giant, but their FY26 results show a company that's evolving at breakneck speed. So we're going to break down exactly how they're pulling this off. We'll look at their strategic roadmap and dive deep into the three-engine growth story that is just propelling them forward. All right, let's get right into it. Right off the bat, I want to hit you with the big reveal. Just look at this number. Amber absolutely crushed the 12,000 crore revenue milestone. To be exact, they hit 12,186 crore rupees. That is a stellar 22% year-over-year growth. And honestly, what makes this so incredibly impressive is that they pulled it off despite some very real macroeconomic headwinds and a room air conditioner market that was basically flat because of weird weather patterns. They didn't just survive the year, they completely powered through it. Okay, so here's our roadmap for this explainer. We'll start with their milestone and strategy, then break down their three core engines: consumer durables, electronics, and railways and defense. After that, we'll tackle some margin pressures they're facing and wrap up with their future outlook. Starting off with Section 1, Milestone and Strategy, Balancing Volume and Value. To really understand Amber today, you have to realize they're meticulously building a diversified B2B manufacturing behemoth. To get the real story, we're going straight to the source material, the official FY26 earnings conference call transcript. We are pulling insights directly from the top, Chairman and CEO Jasbir Singh and CFO Sudhir Goyal. It's absolutely crucial to hear it straight from management when unpacking financials this complex. Management essentially described their B2B strategy as this delicate, calculated balancing act. On one side, you've got the volume play. Think massive manufacturing scale that gives them incredible purchasing leverage and efficiency. Then, on the other side, you have the value play. These are the higher margin, super sticky businesses with huge barriers to entry, things like industrial automation, power electronics, and aerospace. By perfectly balancing these two forces, Amber is creating a highly defensible corporate machine. Moving on to Section 2, Engine 1, Consumer Durables. Looking at the actual engines driving this ship, consumer durables is their most established division by far. It still commands the absolute lion's share of the revenue pie at 74%. This core AC and durables business is the heavy lifter. It's the stable foundation that allows them to take those calculated risks in other sectors. And wow, the resilience of this division is just something to behold. They posted 8,383 crore rupees in FY26 revenue, which is a solid 14% growth over last year. Remember, the broader room air conditioner, or RAC industry, was largely stagnant this year because of those unpredictable weather patterns. Yet Amber still managed to grow, holding on to a dominant 26 to 27% market share in RAC manufacturing. Plus, they're not just resting on their laurels. They've actively augmented their capacity at the Sri City facility down south, and their non-RAC business now actually makes up about 32% of their consolidated revenues. Now, here's a number that definitely caught a few analysts off guard during the earnings call: 29 days. That's Amber's net working capital days. Now, that is a huge jump from just 9 days the previous year. So is this a bad sign? Well, actually, no. Management made it very clear that this is a proactive geopolitical defense strategy. Because of all the global supply chain chaos right now, Amber intentionally front-loaded their inventory for critical components. They purposely chose to tie up a bit more capital just to guarantee they could fulfill their customer contracts on time with zero disruptions. It's a really smart defensive move. Okay, Section 3. Let's shift gears to Engine 2, Electronics. If consumer durables is their steady bedrock, electronics is literally the rocket ship. I mean, this division saw a staggering 49% year-over-year revenue growth, hitting 3,268 crore rupees. To put that in perspective, when Amber acquired Iogen back in 2018, it was a 300 crore business with around 3% EBITDA margins. Today, the electronics division is nearly 11 times that size and is aggressively pushing toward double-digit margins. That's incredible scale. So how exactly did they do it? Through some brilliantly strategic additions and acquisitions. They integrated Power One Microsystems, brought Shogini on board for multi-layer PCBs, and they just recently bumped up their stake in Unitronics Israel to 50.4%. That gives them majority ownership in the rapidly growing industrial automation space. These moves are exactly those sticky, high entry barrier value plays we talked about earlier. Next up, Section 4, Engine 3, Railways and Defense. This is where Amber really gets to flex its engineering muscle. The division delivered a really solid 19% revenue growth, reaching 535 crore rupees, with operating EBITDA growing by 8%. But honestly, the absolutely crucial metric for their future, it's that massive figure right at the bottom. They are sitting on an order book of over 2,600 crore rupees. That gives them insane revenue visibility for the next few years. Oh, and their brand new greenfield facility in Faridabad, which does HVAC, pantries, and automated doors, that's all set to start commercial production this quarter. All right, let's talk about Section 5, margin pressures. Of course, no business journey is perfectly smooth. And for Amber, the current dramatic tension is an expected temporary 50 to 100 basis point margin squeeze at the consolidated level. So why the squeeze? Well, just look at the staggering spikes in critical raw materials globally. Copper-clad laminate, which is absolutely vital for printed circuit boards, has shot up by 60% over the last year. Gold prices, also heavily used in electronics, up 60% as well. These are massive, completely unavoidable cost headwinds hitting manufacturers all over the world. And it's not just the global commodities. Let's factor in these other headwinds. Amber got hit with some sudden localized minimum wage hikes. We're talking a huge 35% jump in Haryana and a 22% hike in UP. You combine that sudden labor cost increase with currency depreciation, making imports a lot more expensive, plus the incredibly rigid fixed-price nature of Indian railway contracts where you just can't easily pass costs on. And yeah, you can totally see why their margins are feeling the pinch right now. Now, all these factors create a very specific challenge for the electronics division. See, in their traditional RAC business, Amber is a Tier 1 supplier. That means they can pass on commodity cost spikes to their customers almost immediately, usually with just a one-quarter lag. But in the printed circuit board, or PCB business, Amber actually operates as a Tier 2 supplier. They supply the components to Tier 1 companies, who then supply the final brands. Because of that extra layer in the supply chain, Amber faces a much longer 1 to 2 quarter lag in passing those elevated copper and gold costs along. So it's a temporary timing squeeze, but a very real one for their bottom line. Finally, Section 6, Future Outlook and CapEx. You know, Amber isn't a company that dwells on temporary hurdles. They are looking way past these short-term pressures, committing a massive 1,800 to 2,000 crores to an incredibly ambitious capital expenditure plan. A huge chunk of this is going straight into their PCB facility expansions. They actually broke ground on the Ascent K facility in June 2026. Their Hoster facility is slated to hit commercial production by mid-Feb 2027, and by late FY28, Ascent K will begin trial production for advanced HDI circuit boards. Management framed this perfectly during the call. They called it an import substitution story. They are heavily investing in asset-heavy infrastructure to literally ensure India's self-reliance in the electronics manufacturing ecosystem. And because of these massive investments, plus those robust order books we talked about, management has confidently set some seriously aggressive growth targets for the upcoming year. They expect the electronics division to grow by an astounding 40%. They project the railways and defense division will grow by 30 to 35%, and they expect their core consumer durable segment to track nicely alongside an industry volume growth of roughly 12 to 13%. They are absolutely firing on all cylinders right now. So, as we wrap up this explainer, I really want to leave you with this final thought. Amber has proactively fortified its supply chain against major global shocks. They are rapidly scaling up two incredibly high-margin B2B engines, and they are literally laying the concrete for India's electronic independence. With all these pieces falling into place, with a fortified supply chain and rapidly expanding high-margin engines, just how much more market dominance will Amber capture? It's a fascinating question for a truly fascinating company. Thank you so much for joining me to explore this topic. Keep learning, keep analyzing, and I will catch you in the next explainer.